In this episode, we will explain divergence. For most new traders, it's a revelation. Most fake gurus sell these courses as the super hidden secret that will ensure success in financial markets. The truth is far beyond that. Divergence simply occurs all the time in all the time frames as the market constantly changes momentum and behavior. But first things first, let's see what exactly are these divergences and how to use them properly. Divergence can be seen by comparing price action and the movement of an indicator or oscillator. It doesn't matter what indicator you are using, stochastic, MACD, RSI, and so on. If you take a look at these indicators, you will understand that many times we might observe a difference in the readings of the actual market and our indicator. The great use of divergence is that you can use them as a leading indicator and identifying a potential in the market. As the market first changes momentum and prices follow, divergence can help you enter your trades or use them as an extra confirmation signal. Divergence occurs when the prices is making higher highs but your indicator or oscillator is making lower lows. Simply when the prices of the market is moving in the opposite direction of your technical indicator or oscillator. Now you probably ask, how is this possible? Well, all indicators are using mechanistic calculations. However, the market behavior is pure psychology. Divergence trading is a useful tool to have in your toolbox because divergence signals that the market is changing behavior. Again, it doesn't mean that the market will reverse, but it is a sign you need to pay attention to. Using divergence trading can be useful in spotting a weakening trend or potential reversal or a trend continuation. There are two types of divergence. Positive divergence that signals prices potentially will go higher. It occurs when the price it moves lower but your indicator is moving higher or showing bullish signals. The second type is negative divergence that signals prices potentially will go lower. It occurs when the price is moving higher but your indicator is moving lower or showing bearish signals. You will hear several other definitions like regular divergence, positive, negative, extended, hidden, and so on. When you will understand what they are, you don't have to worry about knowing these definitions by heart, and that's why we are here. In the positive side, we have regular and hidden divergence. Regular means that the market will reverse, while hidden divergence is a signal that the market will continue in the same trend direction. A regular divergence is used as possible sign of a trend reversal. A regular bullish divergence we have when the price is making lower lows, but our oscillator or indicator is making higher lows. This normally occurs at the end of a downtrend, as the market is showing signals that is running out of steam. After a second bottom, if the oscillator fails to make a new low, it is likely that the price will rise, as price and momentum are normally expected to move in the same direction. We have also hidden bullish divergence, can be seen when the market is in a very strong trend. Once the price makes higher low and the oscillator makes lower low, then we've got some hidden divergence. The reason it's called hidden is that it's been hiding inside the current trend. On the opposite side, we have the second category, negative divergence. If the price is making a higher high, but the oscillator a lower high, then you have normal bearish divergence. This type of divergence can be found in an uptrend. After the price makes the second high, if the oscillator makes a lower high, then you probably expect the price to reverse. The idea is the same. As the market loses momentum, we see the readings in the indicator. The hidden bearish divergence occurs when the price makes lower high but the oscillator is making a higher high when the market is in a downtrend. When you see hidden bearish divergence is a signal that we are in a strong trend. Keep in mind that the regular divergence are possible signals for trend reversals, while hidden divergence signal trend continuation. Goes without saying, and as we keep saying in every episode, we will do the same in this one. Trend is your friend, no matter what indicator you are using. So first, you need to identify a trend. While you are expecting the market to retrace, you You have studied your Elliott waves, your golden ratio, you know how to use support and resistances. You are ready to use divergence. Divergence will be the finishing touch in your entry. Again, you will see several live trades in our live channel, and to be honest, I do not use divergence, and I will explain later on why. Here we are demonstrating best practices, but the market is unpredictable. Again, you will do several tests and demos, and you will come to my words. But in any case, your personal experience cannot be compared with any example out there. When the market is starting to retrace and you have identified a proper retracement, you are ready to use divergence. In our example here, we see that the market loses steam in the retracement. We are ready to follow the main trend and shoot the market. The indicator starts to diverge. Now divergence might be more intense and obvious. This will work as a self-fulfilling prophecy, as most traders will jump into the market. In this case, you might have some extra technical confirmation like patterns, advanced or simple ones. Divergence is a really good detector of market momentum. Use divergence wisely and not as a stand-alone signal. In this example, as we took a live trade, I was expecting the price to retrace. As we are in a downtrend, the market hits a golden ratio level. Also, the prices retrace close to the previous resistance. Here, I'm noticing some divergence in the market. As you can see, I have used many criteria before entering this particular trade, and also some simple moving averages. Divergence was the last thing I was expecting, and I would take the trade no matter if we had divergence or not. Divergence can work as a very sensitive early market direction detector. They can be useful as leading indicators, as they have the potential to identify future market behavior. They can have a really good synergy with other market tools like trend indicators and other technical tools, as we described in this episode. They are really good to provide optical mechanistic signals that they are very easy to understand and to use. On the downside, divergence will occur everywhere in any time frame. As oscillators and indicators are using strict math calculations, the real price will diverge all the time in all time frames. You will have several false signals. They cannot be used as a stand-alone method in the market. Eventually the market will reverse, so you don't have an accurate signal when exactly it will reverse. That's it. Thank you for watching. Go back, repeat the chapters you are not sure, and trade safe.